This week's Market Monitor has 3 picks for your portfolio that he thinks are poised to improve over the next 2 quarters. He's Mark Luschini, Chief Investment Strategist at Janney Montgomery Scott. During his last appearance in March, did pretty well. Mark recommended P&G up 5%, AT&T up 14%, and Eaton, which is higher by 16%. Welcome, Mark. You still sticking with those 3? You still like them?
Certainly 2 of the 3, Tyler, particularly Eaton and AT&T, attractive dividend yields, still very reasonable valuations. I wouldn't necessarily bail out of Procter & Gamble, but the fact of the matter is it's trading at about 20 times forward earnings, and I still think has some prospects for changing around its portfolio of products to help to improve growth rates, but that would be the one I'd be inclined to perhaps remove in order to make some room for today's 3 picks.
Well, let's get right to that. We start with the iShares Biotech.
Well, Sue, that's a space that we found recently very attractive. Several weeks ago, we went long exposure to biotech stocks. Rather than trying to pick the best house in the neighborhood, we're just trying to get the neighborhood right. So we came at it through IBB, the ETF that represents biotech stocks. The fact is, healthcare obviously has strong demographic underpinnings, but on top of that, there's increasing M&A activity in that space. A lot of the drug companies are looking for ways to reach out and ignite their R&D efforts through acquisition as opposed to intra-company investment, and we think that space ought to be able to prosper as a consequence. It did real well last year, got completely slaughtered, and now trades at very reasonable valuations in our view, so I think its prospects are good.
Your next pick is a little small, obscure, small cap in Redmond, Washington. Tell us about it.
Perhaps your viewers have heard of it, Tyler. It's called Microsoft. It's sitting on bundles of cash, a company that's actually growing rather nicely, and it's a cloud play. So as companies continue to outsource their computing databases, they're looking for firms, not just like Microsoft, but Amazon, Google, and others, to do that for them. The difference between the others and Microsoft is Microsoft trades at about 20 times earnings on a go-forward basis, which is reasonable when compared to many companies in the tech space, let alone their cloud-based counterparts. In addition, it pays just above a market dividend yield, so you get a handsome coupon as you own a cloud-based computing company that is doing a good job and it's an iconic brand.
And Cisco rounds out the 3.
Yeah, again, here's an iconic technology company, been out of favor for a long time, but what we're starting to see is telecommunication companies that have underinvested in communications equipment, and you mentioned another that had done real well on today's news, are starting to see the benefit of that underinvestment now finally turn around, where these telecoms, the AT&Ts and Verizons of the world, are trying to repair and restore their communication network capabilities. And so Cisco's a beneficiary of that, trading at just 13 times forward earnings against a market multiple of 17 times, and once again, a slightly above market dividend yield.
All right, Mark, thank you very much. As always, good to have you with us. Mark Luschini with Janney Montgomery Scott.